Most people don't go broke because they lost their job. They go broke because of one decision, a decision that felt small, safe, even smart at the time. You can earn a six-figure salary and still end up poorer than someone earning half as much. The difference isn't income, it's the size of your worst financial mistake. In this video, you'll see the real numbers behind the costliest financial errors people make, with one mistake capable of destroying over $1 million in future wealth. And the most expensive mistake isn't a scam, a bad stock, or a failed business. It's something almost everyone believes is the safe choice. Stick around, because by the end, you'll know exactly which decisions to avoid, and which ones quietly build wealth for decades. The main problem: roughly 2 out of 3 people admit to making at least one seriously damaging financial decision in their life. Nearly half say they've made more than one. The median cost of these mistakes is $5,000, but because a few decisions are catastrophically expensive, the true average cost jumps to $23,000 per mistake. A handful of errors don't just cost money, they erase decades of future wealth. Why it happens? Most of these mistakes aren't about bad math. They're about emotion overriding strategy, panic, fear, pressure, or simply not knowing the rules of the game. And the most expensive one of all happens quietly inside your own investment account. The behavior gap. Panic costs more than any bad stock. The single biggest destroyer of long-term wealth isn't fees or picking the wrong stock, it's behavior. Financial researchers call it the behavior gap, the difference between what the market actually returns and what investors actually keep, because they buy high out of excitement and sell low out of fear. Here's the real math. Invest $100,000 for 30 years at the market's historical return of 10.65%, and it grows to about $2,036,000. But the average retail investor who panics and jumps in and out of the market only earns 7.13%, turning that same $100,000 into just $794,000. That's a $1,241,600 loss. Not from a crash, from reacting to one. On a larger scale, a $500,000 portfolio compounding at 8% for 30 years grows to roughly $5 million. Drop that return by just 2% from panic selling during downturns, and the final value falls to $2.9 million. A $2.1 million panic tax. Buying too much house. The second expensive mistake is stretching to buy a home you can barely afford, assuming your income will only keep rising. But careers peak. In high-pressure professions, income typically plateaus and starts declining around age 50, right when many people are locked into their biggest mortgage. Consider a $2 million down payment on a $4,500,000 home. That money, if invested safely at 3.1%, would generate $62,000 a year in passive income. Instead, it sits frozen in a house. Add annual housing costs of $223,254, and the true cost of ownership is $285,254 every year. Property taxes alone can add up to $1.2 million over 20 years. And if you're forced to sell during a downturn, realtor fees and transfer taxes, a minimum of 5%, mean an automatic $225,000 loss before the home's value even drops. Marrying the wrong financial partner. Choosing a partner with hidden debt, compulsive spending, or financial dishonesty can drain a lifetime of savings, sometimes through fraudulent balance sheets used to hide defaulted debts. And divorce compounds the damage. A major mistake here is trading retirement savings for home equity to keep the house. It sounds fair, but it isn't. Retirement money is pre-tax and penalized if withdrawn early. Home equity has zero liquidity and future tax exposure. On top of that, forgetting to file a qualified domestic relations order for retirement accounts can trigger full income tax plus a 10% penalty on the entire balance. An expensive paperwork mistake. Waiting to start saving time, not income, is the most powerful financial asset you have. Take 2 people. Liz starts investing $100 a month at age 25, stops after 15 years, and never contributes again. Jenna waits until 35, then contributes $100 a month for 30 straight years. Double what Liz put in. At age 65, Liz still ends up with more money. The 10-year head start beats double the contributions. Co-signing a loan. Co-signing feels like a favor. Legally, it's a full financial commitment. About 1 in 6 adults has co-signed a loan. And nearly 4 out of 10 co-signers end up paying some or all of it themselves after the borrower defaults. Another 28% see their own credit score drop because of someone else's missed payments. Lenders can demand full repayment from the co-signer immediately, without even trying to collect from the original borrower first. And a quarter of co-signers say it permanently damaged the relationship. A damaged credit score taxes you for decades. Your credit score isn't just a number for loan approval, it's a lifetime tax rate. Over an average adult life, Americans pay off close to $1,786,810 in total debt across mortgages, student loans, cars, and credit cards, with $649,067 of that being pure interest. If your credit score falls into subprime territory, lenders raise your rate to cover the risk, and that alone can cost over $157,900 in extra interest over a lifetime. Credit cards make this worse. The average card balance is $6,618 at an average APR of 22.83%. Pay only the 2% minimum, and it takes more than 7 years to clear that single balance, costing $3,610 in interest on top of what you already owed. And it doesn't take a big purchase to start the damage. An overlooked subscription on a forgotten card can quietly trigger late fees, collection referrals, and years of credit score damage. All from something that cost a few dollars a month. Real life. Example, imagine 2 people, same income, same starting point. One builds an emergency fund, invests early, avoids co-signing loans, and buys a home within their means. The other panics during a market dip, overextends on a house, and co-signs a family member's car loan that later defaults. After 20 years, their net worth isn't close. Same income, completely different outcomes, because of decisions, not paychecks. Mindset shift. A fixed mindset says, I already made my big mistake. There's nothing I can do now. A growth mindset says, the size of my next decision matters more than the size of my last one. Every one of these costly errors is preventable, not through more income, but through more awareness. Practical action steps. You don't need to fix everything today. Pick one. Write down your loss tolerance before you invest, so panic doesn't decide for you. Keep your mortgage well below your peak income, not your projected future income. Before co-signing anything, ask if you could absorb the full balance alone. And if you're not investing yet, start this month, even with a small amount. Time will do more work than the amount ever could. The most expensive financial mistake isn't one bad investment or one unlucky year. It's letting emotion, fear, pressure, urgency make decisions that math should be making instead. The people who build real wealth aren't the ones who never make mistakes. They're the ones who understand which mistakes are too expensive to make twice. If this video changed how you think about your money, subscribe for more breakdowns on financial literacy, wealth building, and the hidden costs nobody warns you about before it's too late.